Welcome to this video. Today we will be talking about the break-even point, its graphical representation, and its calculation and its interpretation as well. So first of all, you must be understanding what is break-even point, the sales level at which the business is at no profit or loss situation. Or in other words, we can say the business is covering its cost from its total revenues. So we can say the other definition of break-even point is the sales level at which the business total revenues are equal to total cost. So business is covering its all costs from its total revenues. Or in other words, we can say the break-even point is the sales level from where profitability starts. After that, profitability will start. So here is the definition of break-even point. I repeat, the sales level at which business is at no profit, no loss situation. Let's draw its graphical representation. Here we go. Here is on x-axis, I'm taking production or number of units. Okay. And on y-axis, I will be taking total cost curve, total revenues curve, fixed cost curve. Okay, so on y-axis, I am taking these values. On x-axis, I am taking number of units. Okay, now I'm taking the interval of 100 units on x-axis. You can take any interval depending upon the situation and the graph, 300 and 400. Let's suppose our capacity to make a number of units in one factory or in one business unit is 400 units. So, and the rent of the factory is $10,000. By default, the cost which does not change with the change of units is fixed cost. You already are familiar with this terminology. Fixed cost means the cost which does not change with the change of units. It remains constant, but up to a certain level of an activity. So if you make no unit, even then you have to pay fixed cost, which is 10,000. So on zero level of activity, the cost exists. But if you keep producing some goods, the fixed cost will not change, but up to a certain limit. So our limit is 400 units in one factory. So we can draw a fixed cost curve, will moving straight curve like this. So this is fixed cost curve. Regardless of the number of units, the fixed cost curve will look like this. Okay, so this is total fixed cost curve. Now coming to revenues, the total revenue curve. Basically, revenue means the price the business charge from customer after delivering the goods or providing the services. That is revenue. Okay, now if you sell one single unit, then you will charge something, and if you do not sell any single unit, there will be no revenue. It's obvious. So revenue means the price you charge after delivering the goods or providing the services. Its curve will be starting from zero and it will move like this upward. So this is total revenue curve. Okay, now coming to total cost curve. Total cost, by the way, to make it more clear for you, total cost is equal to fixed cost plus variable cost. And by the way, variable cost means the cost which changes with the number of units. If you are producing more number of units, the variable cost will be more. If you are producing less number of units, the variable cost will be less. So the cost which totally changes with the change of units is variable cost. But the formula for total cost will be fixed cost plus variable cost. Let's draw this on the graph and then we will see this. So its graph will be starting from $10,000 because 10,000, 20,000, 30,000, this is the interval. Okay, but why the cost is starting from 10,000? Why not from zero? Because even at zero level of activity, there is a cost which is fixed cost. So our total cost curve will be starting from this point and it will move like this one. Okay, this is the total cost curve. Now, this is the time to define what is break-even point and to elaborate what is the loss region and what is profit region. Here we go. So if you see this graphical representation on a point where the total cost is just equal to total revenue curve. So this point, the total revenues are just equal to total cost curve. This is the break-even point, the sales level at which our total revenues are just equal to total cost curve. But before this break-even point, the shaded area, which is in the red color, you can see this shaded area is showing that total cost is greater than total revenues. It means this is the loss region because we are not covering the cost from our revenue. So this is our loss region. Okay, here we go. We have another region, which I am highlighting with the green color. The green color is showing that we are in the profit region. Why? Because our total revenues, you can see revenues are up and cost is down. So total revenues are greater than total cost curve. So this is the profit region. So here we have elaborated the break-even point is the sales level at which the business is earning no profit, no loss, and total revenues are just equal to total cost. And the profitability is starting from this point. So this is the break-even point. But what about this total revenue curve? Look at this. If you draw this total revenue curve to down to x-axis, it means this is our current sales revenue, which I have drawn this. So this is our current sales revenue. Okay. So, but if we start declining from our current sales revenue to downward, okay, our current sales revenue is this one, and the break-even point is this one. But in between the current sales revenue and the break-even point, this region is margin of safety. Basically, margin of safety means if we start declining from our current sales revenue, then we will how much decline is acceptable from our current sales revenue. So the decline is the difference between the current sales level and the break-even sales level. So we got to know the formula of margin of safety will be equal to current sales revenue minus break-even sales. Very simple. Okay. Now I have to elaborate one more graphical representation, and then we will be able to put a numerical question here. So you can see here, this graph is representing something. Okay. Now I am taking this picture and I will elaborate this on my smartboard lesson. Okay, here you can see this graph, we have to label it. This 6,000 number of units, this is the break-even point at which our total revenues are just equal to total cost. So this is the break-even point. We can see this is break-even point because 6,000 units at which total revenues are just equal to total cost curve. Okay, this is this break-even point number of units, 6,000, and fixed cost is, this is the fixed cost curve, total fixed cost curve. Okay, now the point is the curve which is starting from fixed cost, moving this one, this is total cost curve, and this is total, I'm sorry, the curve which is starting from 0 till onward, this is total revenue curve, and this is total cost curve because it is starting from fixed cost. Okay, so this is our current sales revenues, which is 7,500. This is the break-even point, and the difference between break-even point and 7,500 minus 6,000 number of units. This is our margin of safety. These means that how much decline in the sales, current sales is acceptable. We can accept 1,500 units to be declined. But what will happen after this? If we keep declining from 6,000 onward, then we will be reaching in the loss region, which I have highlighted in my drawing, the graphical representation. That's the loss region. And if we are in between the break-even point and the current sales level, this is the profit region. I hope that you understood the graphical representation